And ladies and gentlemen, we move on to the keynote address 1, which is titled, Where is the Precious Metals Market Headed? To deliver the keynote, we have with us Ms. Rhona O'Connell, Head of Market Analysis, EMEA and Asia Region, INTL FCStone. Allow me to introduce her. Rhona O'Connell has over 30 years experience as a commodities analyst and is a recognized authority in the precious metals sector. She has worked as a metals market analyst in many aspects of the industry, including the mining sector, commodities broking at Rudolph Wolf, where she was a major contributor to Wolf's Guide to the LME, and in the equity markets and investment banking, where at Shearson Lehman, she was the group precious metals analyst responsible for advising a wide range of market participants from trading through equities to corporate finance. She has held Extel ranking second place in the gold sector and has been the Association of Mining Analysts Commodities Analyst of the Year. She is also a regular contributor to the media and has a large number of speaking engagements to her name. After a number of years running the GFMS team at Thomson Reuters, she is now the head of market analysts at INTL FCStone, where she is developing a team of analysts to support the EMEA and Asia sectors in particular. She holds an honours degree in law from the University of Cambridge. Ladies and gentlemen, let us warmly welcome Ms. Rhona O'Connell, please. Welcome.
Good morning, ladies and gentlemen. Thank you for coming to join us in this third SBMA conference. It's a delight to be back in your lovely city again. I wish I could be here more frequently than I have been in the past, and hopefully that will come about. Thank you for your kind words of introduction. I propose to take a quick look at the gold market for you, and the presentation essentially falls into two sections. And while I outline what those are going to be, there is our mandatory disclaimer for you. Essentially, we are looking initially at the professional market, how gold interplays with other asset classes, and then I'll move on to look at the attitude of private individuals and their purchasing or trading patterns. Then we pull it together at the end by looking briefly at commodities of traders, the exchange-traded funds, and a further slightly more specific look at gold and the equity markets. So, to what extent is gold still a safe haven? Looking at this one, you wouldn't say that it is at all. This is a 5-year view, as you see, of the S&P 500 against gold. The one has a gain of just under 44% over the period, the other one a mere 6%. Looking at the ratio of the S&P 500 to gold, it has certainly been argued over the last few months, not least by me, that it was looking pretty toppy, and that the time was coming when the relationship needed to revert more towards its long-term mean. In fact, if you actually look back towards the start of the 1990s, we're nowhere near the high, which was of the order of 5.6 to 1. We're now looking at about 2.13. The long-term average is 1.6. That trough at the start of the 1980s, I'm sure there are people in the audience who will remember, was essentially in response to the second oil crisis, whereby we had gold when the Middle East at that stage was the largest consumer on a regional basis. Now, of course, it's Asia, particularly East Asia. And gold was trading at $850 at its peak. The oil price was very high, and by definition, therefore, we were looking at a combination of inflation and recession, and the equity markets reacted accordingly. And at that point, obviously, we saw the bottom in the S&P gold ratio. Now it's actually looking broadly stable. Of course, the relationship changed last week with gold jumping up towards $1,350 an ounce, but it looks for the time being as if things are broadly settling down in the roundabout the 2.1 region. So, moving on, this is a mere snapshot. It's the 5-year average of the simple log correlation of gold against major asset classes. And you can see here that the TIPS index, which is the inflation discounted bond index in the United States, and the 10-year bonds are showing relatively high correlations. Brent is positive to the tune of approximately 8%, Real estate index, the REIT, that's also positive, but to a lesser extent. And you will not be at all surprised to see, particularly on the back of the chart that I showed you a couple of minutes ago, that the relationship with the S&P is broadly zero. Generally, it's slightly negative. And then, of course, the trade-weighted dollar is a law unto itself in this particular in this particular context, where we're looking at deep negative territory. So I'll run those through very quickly, just in a little bit of detail for you to give you an idea of what the profiles actually look like. Gold against the 10-year bonds. It's a relatively high correlation in a low interest environment, but in a high interest rate or inflationary environment, the relationship is vastly different. So here, as I showed you just now, we're looking at just under 40% for the average. But in the 1980s, for example, we were down at minus 2%. 10-year bond index has averaged approximately 40% over the past 5 years and is generally positive, in contrast to the real estate, which is negative as often as it is positive. And again, you can see how volatile these relationships are. And I will come to a conclusion on this in a moment, but this is just, as I say, to give you a background idea of the volatility between the different asset classes with respect to gold's performance. S&P 500, we're even more into negative territory on a timeline basis. On average, as I said, it works out at more or less zero. The TIPS index has been pretty strong. It's been, majority of the time, it's in positive territory. Now, arguably, this is because we're looking at gold as a potential inflation hedge. There are many market commentators, certainly in the Western world, who would say that gold is not an inflation hedge, but the simple reason behind that is because at the moment, in a lot of industrialized nations, there are no strong inflationary forces. Although there are some commentators who would suggest that with the amount of liquidity that's in the system and has been building up over the last 10 years or so, there is the possibility for inflation to break out in the medium term. Oil is an interesting one. This relationship has essentially broken down. We spend marginally less time in negative territory than we do in positive where the correlation is concerned, but it is hugely variable, this one. In the period that I mentioned before, with the second oil crisis in the late 70s to early 1980s, the correlation was a positive 16%. Over the last 5 years, however, it's been 0.08%. And again, to some extent, this comes back to the argument that I've just outlined about inflationary forces or the lack thereof. And here we come to the dollar. The important thing to note here is that when gold is referred to as a safe haven, the debate almost invariably springs up, yes, fine, gold is a safe haven in certain instances, particularly if you're looking at geopolitical risk, but so is the dollar. And here, you can see a graphical illustration potentially as to why. Now, this is not a 100% compelling argument, but it is of interest to note, if you look at the profiles on these charts, there are something like 30 time periods in which the correlation between gold and the dollar has been strong. And if you look at the lower chart, the red line, that is the VIX Uncertainty Index. And for something of the order of 60% of those periods when gold and dollar have been working in tandem with one another, the VIX index has been strong. So, as I say, it's not fully compelling. 60% is not, it's not 100%, but it's pretty strong overall. And this does at least give us some graphical illustration as to the anecdotal comments that gold and the dollar can work together as a safe haven. So yes, gold is a safe haven, but it's not the only one. Now, this context, as I said at the outset, is the professional classes when it comes to looking at gold as an investment or as a hedge against risk. So what I want to do now is to move on to the physical side of the market, and in particular, the Asian markets and Asian attitudes towards gold, and to discuss whether the Asian gold market is losing steam. Now, for these purposes, the areas that we need to look at essentially are jewelry, investment bars, and coins and medals. The exchange trading products are more geared towards the Western markets, or the Chinese markets are evolving. The World Gold Council reports, for example, that there were just under 16 tons held in the two major mainland Chinese funds as of the end of April of this year. I also want to point out to you the important difference between Western jewellery products and those in East and South Asia and the Middle East. So, gold jewellery, adornment versus investment. If you have a look at this histogram here, the red bars, you can see how high they were back in the year 2000, and the declining profile right the way through. Now, this is what is categorized in the legend here as, quote, others, which is essentially Europe and North America. And the importance here is that jewelry in Europe and North America, as far as gold is concerned, is much more of an adornment than an investment. And that is very largely for the simple reasons of caratage, whereby I'm ashamed to say that in Europe, the vast majority of jewelry demand is 9 carat, which is 37.5% gold, and in my view should not be called gold jewelry at all, but that's just a personal view. In North America, it tends to be 14 carat, which is 58.5%. And over the course of the past 18 years, you can see how the elements in this particular geographical sector has suffered. That's partly economic activity. The year 2008 and the financial crisis was something of a watershed, and the market has not recovered at all, and it's particularly so in the case in Europe. Regional bar demand, by contrast, has been comparatively strong, but broadly flat over the last 3 to 4 years. Now, importantly here, you see the big outlier in 2013, and this to some extent is where the professional and the retail markets came together with the hemorrhaging of something like 880 tons of gold out of the exchange-traded funds, particularly those in North America. And the vast majority of that material came across into East Asia, particularly into China, where there was a massive surge into bar and particularly jewelry purchases. Now, I'll come back to that again shortly. The point that I would make here is looking back at the jewelry that I've just shown you and the bars that we have here, in Europe, gold content in jewelry plus bar demand has halved over the past 18 years from approximately 1,100 tons to 540. And the slack has been taken up in East Asia and the Indian subcontinent predominantly. So to look at that in terms of tonnage, East Asia is the bottom profile here in green. You have the Indian subcontinent above it, then the others, and then the Middle East on top. And this is just a very simple chart to show you tonnage. And basically, you can see how East Asia pushed the profile up in 2013, and obviously we had a retracement after that because that momentum could not possibly be sustained. In fact, the market was heavily overbought at that point, and it took some time for it to work its way through. But now it's broadly flattened out. And Asian retail gold demand, this I've just taken the other profile. Excuse me, my machine seems to have stuck. There we go, that's better. There I've just taken out the others to show you the profile, very similar again, but just to emphasize the changes. But if you then ascribe a notional dollar value, the picture is very different. Now, this can only, by definition, be approximate because we're working on annual numbers, but essentially all I've done here is just take tonnage and multiplied it by the average annual price. So it's only a proxy, it cannot possibly be 100% accurate, but the profile speaks for itself. And again, same thing, I've just stripped out the others here just to show you in finer detail what Asia has been doing. And again, you can see here it's broadly steady now, around about the $100 billion level. Now, if you add in the ETFs, or I beg your pardon, if you add in ETFs to this, they smooth the profile, showing that to some extent, ETF activity has helped to take up the slack that we saw earlier in falling bars. This is not to say that ETFs have been working at the cost of bars, because the constituents of ETF holdings and small bar buyers tend to be different. In silver, it's actually a different case, because a lot of the holdings of silver exchange-traded funds are in retail hands. In the gold sector, it tends to be much more than professionals. So, as I said, we had 880 tons came out of the ETFs in 2013 and went into jewellery and bars, which that year, and this is coincidence, if anything, it's slightly too neat a coincidence, but the increase in 2013 over 2012 for jewellery and bar demand in East Asia was 620 tons and 260 tons respectively, which comes to 880. It's a coincidence. One thing I would point out here is that also one of the reasons why we've had quite a long time for the market to come back onto an even keel is because of that over-purchasing. It wasn't just the retail sector in its exuberance picking up gold during that period. A lot of banks came into the market, particularly in China, in order to capture the local premium. And I remember talking to a senior banker in the London market at the start of 2014, and he was of the view that it was probably going to take something like 6 months for the oversupply to be worked off. In fact, it took more like 2.5 to 3 years. Same again, I've just gone through the same exercise, tonnage against an annual average price. And while it's certainly arguable that the East Asian market has leveled off in terms of dollar value, in terms of the metal bought last year, it's still pretty vibrant because on this basis, something of the order of $54 billion went into the gold market last year. And with the recent pickup in price, the nature of market mentality suggests that retail purchasers will now return to the fray. Generally speaking, the Asian markets turn quiet when prices are flat, as a good proportion of potential buyers like to see a trend developing and to have their hopes and expectations of increasing prices showing some evidence of reward. This is actually a change. Back in the 1980s and 1990s, typically speaking, an Asian jewelry or small bar purchaser would buy into a falling market, whereas Western investors preferred to see a trend having developed to the upside before they came into play. The Asian mentality has now changed and come broadly in line with the way the Western people have seen things. And as I say, people like to see the bottom of the market and see things turn up so that they can buy in with a reasonable degree of confidence. I think it's arguable that what we've seen over the last 5-6 days or so would mean that for the time being, the Asian markets will be quiet because $50 in 1 week is actually quite a lot to take on board. Now, the ETFs. This is daily dollar flows, obviously the spiked green line, the spiked amber lines there, whereas the green line behind is the amount of tonnage actually within the majority of the exchange-traded funds that are in operation. There are over 2,220 tons. Were they a central bank, this would be the 6th largest central bank holding in the world, with a value of more than 90 billion. One thing that I would point out to you here is that there is a big difference between the market capitalization of the exchange-traded funds and the actual dollar flows. Dollar flows this year amounted to 1.3 billion towards the end of, through to the end of May. While the market capitalization, in fact, was broadly unchanged. It fluctuated, obviously, but if you take a snapshot from the 1st of January to the 31st of May, they were both $91.6 billion. Last week, $5 billion went into the market capitalization of the exchange-traded funds. So we're now standing at $96.5 billion. Looking at the other side of the market, this is just the managed money, which one might term the hedge funds, to some extent speculators, and their positions on COMEX. For the first part of this year, these positions were to some extent under pressure from the long side. There'd been some long liquidation and shorts were gradually building up. So that a fortnight ago, we were standing at a net long of just 50 tons. These weeks end on Tuesdays. The COTR reports on a Friday with respect to the close of business the previous Tuesday. 82 tons the week after that, and then last Tuesday, when the gold market, or the gold price had started moving, hadn't finished, the shorts had come down to 197 tons, which was their smallest since June 2018. And the longs were standing at 497, which is the highest since mid-February. It looks very much with the way the price moved as if that pattern continued through towards the end of next week. And it is arguable, therefore, that the market is now, or the price rather, is now ripe for a correction. Indeed, it is certainly overbought on practically every technical consideration that you care to take into account. LBMA transfers show the market is broadly steady. I would point out here that transfers does not equate to overall volume. I'll come back to that in a second. Transfers is essentially the movement of gold once positions within house have been netted off. And I said that we would wrap up by coming back to a slightly more specific look at the equity markets. I started by showing you the S&P 500 against the gold price over the last 5 years. This actually goes back to 2010, and it's gold and renminbi against the Shanghai A index. And it looks from this chart as if we're looking at pretty much an inverse relationship. So, if you flip over the gold price in renminbi, and this actually works in the majority of equity markets and their local currencies, we can see here that there is broadly, it's not absolutely strict, but there is broadly a good inverse relationship for much of the time between gold and its local currency and what is happening in the equity markets. So to finish, gold transfers, as shown to you on that chart above, does not equate fully to volume. As a rule of thumb, you can multiply the level of transfers as reported by the LBMA on a daily basis by about 3 to get a more accurate reflection of the level of actual turnover. And we estimate at the moment that LBMA Loco London transfers comprise approximately 70% of the world's OTC turnover. So this puts the global market for 2018 at approximate volume of 660,000 tons. And to put that into context, that is approximately 200 times global mine production of last year, with an approximate turnover of 27 trillion. Compare that with the bond market, which is more like 700 per day, and gold is obviously still a small market. But it's liquid and it's deep. It's comparatively stable. Gold does act as a safe haven. It's not the only one, but it is regarded as a hedge against risk both amongst professional investors and amongst the people on the grassroots of the market, and the two do interplay with one another. It is truly a global commodity, and I entirely agree with Tim. Right now, and I think probably forever, it is predominantly a currency. Thank you for your attention, ladies and gentlemen.